G'day guys, welcome back to the Devon Too Good Investing channel. In this video today, I'm going to be analyzing Texas Roadhouse stock and also doing a stock valuation to see what this business is worth paying for so that we don't overpay and get an adequate return with a margin of safety. So guys, before we get into it, make sure you like this video and subscribe to my channel as I be going really deep into these companies and finding some really great investment opportunities. So let's get right into the business overview. What is Texas Roadhouse? They are an American steakhouse restaurant. They have 634 total restaurants, of which most of the restaurants are the Texas Roadhouse branded restaurants. They have 627 of those restaurants. They got 36 Bubba's 33 restaurants and 4 Jaggers restaurants. As you'll soon see, they have very strong financials and key metrics, and they've got a talented and shareholder-orientated management team. So let's move on. How does Texas Roadhouse grow? Well, they've got two ways they grow their business. The first is by building new restaurants, and this in turn increases their store weeks. We'll talk about what store weeks are in the next slide. And then the second way they grow their business is by growing the demand at their existing restaurants. So growing sales at their existing restaurants. And the key metric to understand this is comparable restaurant sales, which we'll talk about after store weeks. So the first key metric is store weeks. Store weeks represent the number of weeks that all company restaurants were open during the reporting period. So in this case, in this graph here, the reporting period is annually, so every year. And you can see over time, the amount of store weeks has increased, and this makes sense because they're building more restaurants, they're opening new restaurants every year. And on the secondary axis here, this orange line, this tells us the year-over-year growth in the store weeks. And you can see on average it's roughly about 6% per year. So the store weeks for Texas Roadhouse over the long term, all the way back dating to 2008, is growing at about 6% per year annually. You can maybe have a look at the growth is downtrending a little bit, but this is fairly natural as the company grows out and grows bigger. It's going to be harder and harder to increase total store weeks at a faster rate due to pretty much the scale. So in order to grow the company at, let's say, 10% total store weeks, it's a lot harder to do that now than what was than it was the case 10 years ago. The other key metric is comparable restaurant sales. This is probably the most important one. So comparable restaurant sales, it reflects the change in sales for all of the company's restaurants over the same period of the prior year for the comparable restaurant base. So it's pretty much how much is the sales growing at each of their restaurants compared to last year. And industry average is round about inflation. So historically, inflation is about 2 to 3%. However, you can see that Texas Roadhouse their comparable restaurant sales is usually in and around 5%. We do have an outlier here in 2020 that was due to the pandemic. And then we've also got another outlier here in 2021. And this was due to them recovering from the pandemic. But if we minus out these two numbers, and of course there's a little outlier here, this was in 2009 during the GFC. Well, you can see it's around 4 to 5% per year on average. And this is much better than the industry average of around 2 to 3%. And the way they grow this is by either increasing the prices at their restaurants, having greater capacity at their restaurants, or maybe they get it by selling more drinks or increasing the total times people return to the restaurant, or by increasing the total bill size. So there's multiple ways they can grow this. But seeing that they're growing faster than their competition, it seems as though that this is probably growing because people are coming back more often to that same restaurant year after year. So if we move on to revenue growth here, we can see that it has been a steady grower over the last, since 2005, because that's how far the data goes back. And if we look at the average growth rates over this time period, they've grown at an average mean growth rate of 14%. And if we look at the median, it's grown at 11.85% per year for a very long time here. This is about 15 years ago. About 15 years they've grown at this growth rate. So that gets a tick. It's clear that they're a consistent grower. If we look at EPS, we got the mean, which I've adjusted. I've taken out some of the outliers here. I've taken out the last 2 years because I think it gave me a funny number and it didn't make much sense. So the mean growth rate of EPS of 13.66% and a median of 12.95. So what this tells us is these are relatively similar. It means margins have also been relatively stable throughout the company's history, which is obviously a fairly nice thing to see. So this company also gets the tick for EPS growth. Very impressive numbers here. Owner's earnings. So this is one of my favorite metrics, and what makes Texas Roadhouse different from a lot of other companies is that the company actually splits out their capex and they tell us exactly what they spend their capex on. So it's actually very easy when analyzing Texas Roadhouse to calculate the owner's earnings. There's no guesswork here. So owner's earnings is the operating cash flow minus the maintenance capex. And because they give us the maintenance capex in their earnings reports or in their annual reports, I'm able to calculate a really accurate number here for owner's earnings. And you can see the result of that on this graph. There's been a median growth rate in owner's earnings of 13% per year since 2008, and then a mean growth rate of 18%. And I think the median growth rate is probably more representative as it does ignore the outliers here. And in 2021, they did $391 million in owner's earnings. So that's going to be very important when we do our valuation coming up. So balance sheet. We want to invest in companies with strong balance sheets that aren't going to go bankrupt and have plenty of liquidity. And Texas Roadhouse has just that. They've got $325.72 million in cash and cash equivalents, and then $100 million in long-term debt. So they've got 3 times more cash than debt. That's good enough for me. I'm very happy with that. On to the management team analysis. So unfortunately, their founder CEO, Kent Taylor, he passed away last year in 2021, and he got replaced by a new CEO. His name is Gerald Morgan, and Gerald has been around working for Texas Roadhouse since 1997. He has 35 years of restaurant management experience, and quite honestly, he's probably the next best thing to Kent, as he's been around at the company for a long time. He understands how the company is run. He understands everything about the company. He is the next best thing to Kent. So that's good to see. In terms of management compensation, they have similar executive compensation to the rest of the industry. So the reason why we want to look at this is we don't want to have a management team that are paying themselves ridiculous amounts of compensation. It should be, based off a fair amount, because obviously if they're paying themselves a lot, that means us as shareholders are essentially paying for that. And they do have some stock-based compensation options. This is based off performance, and the performance hurdle that they have to achieve is 10% EPS growth. So honestly, I'd rather this be a metric like comparative store sales, as EPS can be manipulated through things like share buybacks. However, this company has not been, taking advantage of this. In the past, the company has been run well. They do share buybacks, but they haven't been abusing it just to pump the numbers, which is good to see. We can see that the total compensation for the CEO is $3.7 million. And then you can see the compensation of the rest of the executive team here. It looks high, but considering it's similar to the rest of the industry, I don't see any red flags here. In terms of insider ownership, they do have low overall insider ownership, and I'd prefer to see this higher. And if we compare the CEO's insider ownership, so he owns roughly $7.5 million of Texas Roadhouse stock. And if you compare that to his 3.7 million compensation package here, 3.7 million, that means he owns roughly 2 times the amount of stock than what his overall compensation package is. And for a CEO, I'd personally like to see this a bit higher. So this is like something to watch out for. This is, the reason we want to see this higher is we want the management team to have, and especially the CEO, to have skin in the game. And at the end of the day, I want them to lose money if I lose money, and I want the CEO to get really bloody rich if I get really bloody rich from owning this stock. So it is what it is. I don't love it, but as the management team still is fairly high quality. So if we look here at the return on invested capital, this measures how efficient the management are at reinvesting profits back into the business. And it's been 10% or above for a long, long time, except for the pandemic year. Really impressive. This shows the management team has talent, and they can effectively reinvest cash flows back into the business so it continues growing. So even though that they've got low insider ownership, this metric here shows us that they are still doing a good job at running this business. Now, in terms of valuation, I've used the discounted free cash flow method here. I've used growth rates of between 4 to 12%. A lot of the growth, if we remember owner's earnings, it's been growing at 13% per year over the last 15 or so years. I've entered in last year's owner's earnings number, and then I've entered in their shares outstanding, the required rate of return. This is the discount rate. I've entered in 22% because I want a large margin of safety. Then a terminal multiple, I've put in 15. Now, the company has been trading higher than this over the last 10 years. However, I don't really feel comfortable, baking in a higher multiple in my valuation here, considering that I think the business will grow between 4 to 12% over the next, say, 5-10 years. So I think 15% is a fair multiple. And then I've also added in the net cash on the balance sheet. So this is the cash minus the debt. And then I've put it into a per share value. And you can see that the model says that if the business grows at 4% per year, you should theoretically get a 22% return if you buy the shares at about $52. However, if you think the business is going to grow at 12%, you can get that 22% return if you buy the shares at $70 per share. Now, for me, I probably wouldn't buy this unless it got down to $60 per share or below, and it would be a really great bargain in my opinion if you can get it at around $50 per share. And the reason why I don't like these fourth and fifth models is if we come back to our growth, owner's earnings growth, we did have a massive growth year in 2021. So maybe it keeps growing from here at, the 13%. But I want to be conservative because this is a high base kind of number to go off. It is a bit of an outlier year. So I don't want to be too aggressive with my growth rates just in case it is a bit of an outlier and a pullback, say, this year and the next year. So that's the reason for that. Under 60 is probably good buying. Under 50 is great buying. Guys, I hope you enjoyed this analysis here. Make sure you like this video and subscribe to my channel so I can keep you guys updated with more of my research. And guys, if you're interested in copying my portfolio, links in the description for my eToro portfolio. You can see what I hold in there. And if you're interested, you can copy my portfolio if you wish to. So guys, thanks for watching. Have a good one.